Great, thank you. And I'm excited to be kicking off the new year with something that I think is so critical for organizations and to support HR people. And thank you, Stacy, for reading my book. I'm excited about it. I see a few names in the room that I recognize. So welcome to friends and welcome to new friends. So what we want to do in the next half an hour or so is really talk about how to reframe the topic of diversity in a way that helps human capital professionals actually quantify the impact of diversity on corporate financial outcomes. So for the last decade or so, we've been thinking about diversity from a policy perspective and from a practice perspective. And what we want to do now is we want to transform or reframe our thinking about diversity as a driver of economic value creation for the organization and creating that connection between how we manage the composition of our workforce and how that is actually supporting our organizations in delivering value to stakeholders. Okay, so we're going to talk a lot in the data framework because I'm all about data. If you know me, you know that. And if you're new to learning who I am, it's all about data. And what we want to do today is really think about how we can use data to understand the relationship between DE&I and market value, right? That seems pretty far-fetched, but it actually isn't. To understand how you perform in terms of your DE&I profile against your competitors. And that data is available, so you don't have to scratch your head and wonder how you're going to do that. And also understand how DE&I is actually linked to enhancing the effectiveness and efficiency of your human capital management in your organizations. Okay, so we're going to be talking about these three broad topics, all grounded in data analytics. Today, what we're going to focus on is what stakeholders are looking for. Yeah, so it's, we think about accountability. It's not just, we're doing the best we can, but we have to think about who we're addressing, who we're satisfying in terms of the work that we're doing in this area. So what do stakeholders want? So, for the last 10 years or so, there's been this discussion about stakeholder and stakeholder capitalism. And about 5 years ago, the Business Roundtable really defined who the stakeholders are. And the stakeholders are these 5 constituents: investors, employees, customers, strategic partners, and the communities in which you work. And DE&I really impacts every one of those stakeholders. And to discuss DE&I against all 5 stakeholders in this one session, in this 1.5 hour session, is impossible. So what we're going to do is we're going to actually take these stakeholders one by one. Today, we're going to talk about investors, and we're going to have 4 more half-hour webinars to talk about DE&I and how it impacts the other 4 stakeholders: employees, customers, strategic partners, and community. So this is session 1, and we're really going to focus on the investor because that is the topic that is coming up more often in investor communities, in boardrooms, and if you're a C-suite executive, you know that your conversation around diversity is really amplified over the last year in management teams. So let's talk about what investors are looking for. What they're actually looking for is a material impact, okay? What is materiality? And we can spend hours talking about materiality, but let me just sum it up really quickly. Materiality from a financial point of view, because there's a financial point of view and there's a legal point of view, but let's just talk about the financial point of view. Materiality is any information that would change the investor's behavior if that information is known to the investor, right? So take yourself for an example. If you wanted to invest in a specific stock or a specific index, You would want to know whether or not there's something going on in the company on the immediate or the long-term horizon that would change the financial performance of that organization before you invested in it, right? So let's say, for example, there's a lawsuit in the organization, an employee-led lawsuit that's turning into a class action suit, right? You'd probably want to know whether or not there's a class action suit being brought against the company by the employees before you invest in that company, right? So that's material. Materiality, again, is anything that would change the investor's behavior if that information became disclosed. And human capital is now a disclosable event for SEC filers. And that happened back in 2020, where the SEC said, if human capital performance is material, it would change the investor's behavior if it were disclosed, then it must be disclosed. So this is why this is turning into such a hot topic, why this is what we used to call a burning platform issue, is because there's more and more evidence that DE&I actually has a material impact on sustainable corporate financial performance, and therefore it should need to be disclosed. One last comment about the SEC before we get into this slide is right now the requirements for disclosure are principles-based. So when I started talking about this, I said, if organizations determine that human capital performance is material, then they need to disclose. So it's sort of a judgment on the part of the company whether or not they need to disclose something. We're anticipating this year that the SEC is going to go from a principles-based to a rules-based requirement around human capital disclosure, which means companies can't determine on their own whether or not they need to disclose. Every public company, every public filer, either for equity or for debt filings, are going to have to disclose certain information about human capital. And we anticipate that one of those areas that they will have to disclose is around diversity. So you need to anticipate this. If you're a public company, you need to anticipate that you are going to be required by the SEC to disclose information about the diversity in your organization. And there are lots of companies that have already started disclosing in ESG reports, environmental social governance reports. Some organizations are actually disclosing their EEO-1 filings. Yay, that's transparency, that's good. And we're going to talk about that. So here's the fundamental premise that we work under, and that I think is really relevant for everybody in the audience that's listening. There are three variables that we can look at. We can look at the level of diversity in your organization, which is measured by the Simpson Diversity Index. We can measure human capital return on investment, which is a measure of the effectiveness and efficiency of human capital investments in your company. So everything that you invest in people, wages, benefits, training, development, mobility, performance management, succession planning, non-monetary recognition and rewards, anything that you invest in people, even your holiday parties can be considered an investment in human capital. So anything that you spend on people can be measured and tracked in terms of a return on investment, whether or not what you invest is generating positive impact on your organization. And ultimately, the profitability performance of your organization, right? So that's EBITDA, earnings before income tax, depreciation and amortization, or EBIT, earnings before income tax, or any profitability measure, right? So we think that there's, in these three variables, a strong relationship between the three. Now, there's enough evidence in the literature, both practitioner and academic, that shows that the more diverse companies are, the more profitable they are. So there's already that relationship that shows up. So that's the Simpson Index to profitability performance. But we think that there's something that amplifies that relationship, that explains that relationship. And we believe that that's human capital return on investment. So we think that the more diverse an organization is, the better their performance is on human capital return on investment. And that's a monetary calculation. And we know that there's a relationship between human capital return on investment and profitability performance, because we use the same numbers to calculate the two. They are inextricably linked. So for us to create more profitable performance in our organizations, we have to improve HCROI. And we believe, and we know that the literature shows this, that diversity actually drives better human capital performance in the long run. So we just use the transitive principle. If A equals B and B equals C, then A equals C, right? And we're explaining that diversity impacting profitability performance through human capital return on investment. Okay, so that's sort of a complex thought, hopefully made a little bit simplified. And you must be wondering, well, how do I calculate all these things? Well, here's how you calculate it. It's pretty simple. So human capital return on investment is a very simple calculation. You take the total revenues of the organization and you subtract total expense adjusted for your total cost of human capital. And remember, before I said total cost of human capital is anything that is allocated to human capital budget. So if you're a CHRO, you know what your budget is, and that's what you use to adjust total expense. And then you divide that quotient by the total cost of human capital. So in this way, we're adjusting a profitability result for human capital and dividing that by human capital cost to get a pure indication of the return on investment in human capital. Anything that you spend on people turns into profit. Hopefully it's a positive number, and that's how you calculate your HCROI. The numbers, it's usually like a dollar value, right? So $1.20 could be an HCROI, or $1.50, or $10, or in the oil and gas industry, sometimes it's in the hundreds. And basically what that means is for every dollar you invest in people, what is the adjusted profit resulting from that investment? And we want that number to be as high as possible, right? So for every dollar you invest in people, you want that number to be greater than 1. And the higher it is, the better the return performance is, which means the better the profitability of your organization is, right? So we want to think about how to optimize the return on investment in our human capital investments. And that's one way to think about it. The other metric that we talked about is the Simpson Diversity Index, and this is the formula for it. So it's D, which is the index, the diversity value is basically the sum of every representative ratio of diversity in the organization, right? So you can just use the formula here where small n is the total number of employees in a specific category. And for our purposes, we only calculate race, gender, and ethnicity. But in your organizations, if you measure diversity as LGBTQ, plus if you measure diversity in terms of ability, disability, however you create your categories and add up the total number of employees, you can create this index. And then the denominator is the total number of employees. And you're adding up all these segments of your population to get this diversity index. Okay, so you have HCROI, you have diversity, and you can probably get your profitability performance from your financial statements in your organization. Or if you're a public company, you can just go on finance.yahoo.com and see what your profitability numbers are. So we have this hypothesis, and our hypothesis is that there is a relationship between diversity and market capitalization or market value for public companies. And we say that it's going through HCROI. And what we're testing is that HCROI aspect. What I'm showing you here is this is not our thinking. This is not just our hypothesis. This is what the market is looking at. So Refinitiv Global Diversity and Inclusion Index was picked up by Thomson Reuters, and they did research, and they actually found that the more diverse a company is, the higher their index, the higher the market capitalization is. So you can see the relationship between the orange line, right, and the market cap, which is this axis. So the higher the orange line goes, the higher the market value is. So this is a no-brainer. You want your organizations to be more diverse because more diverse organizations tend to have higher market capitalization. Okay, so we gave you the link here too, so you can go and look at the report if you don't believe what I'm saying here. And this is what we're shooting for. Now, we want to fill that middle piece, right? We want to understand how diversity is driving better performance, market capitalization. And again, we hypothesize that it is through HCROI, human capital return on investment. So what we did is for 26 companies where we have public domain information for 2 years of EEO1 filings, we pulled the filings, we did our analytics, we did an audit, and we pulled the financial information and created an HCROI. And what we found was a very strong relationship between diversity and HCROI. And these are 6 companies where we have public data, and you can see the trend. That is, employee diversity index goes up, or the Simpson diversity index value goes up. The HCROI goes up. On this side, you've got the diversity index, so 0.554 to 0.572, right? In this instance, it's only gone up 1%, but their HCROI went from $2.30 to $2.40 or $2.42. That's huge. Yeah, that's a big improvement that actually makes the company more profitable. So here's American Tower, Apple. So you see there's a relationship that is as diversity goes up, HCROI goes up. As HCROI goes up, profitability goes up. Here's 6 more companies. Costco, Fox, Microsoft, Verizon, right? They all have the same pattern. Here's an interesting other observation, that as diversity stays the same, HCROI goes down. So the message here is diversity is not benign. If you keep the same level of diversity, everything's going to be okay. What we're actually seeing is that's not good. You have to make progress on diversity to improve HCROI, because every organization that had flat diversity had lower HCROI. When your HCROI goes negative, your profitability is impacted. And we know that because it's part of the equation on calculating profit, right? So here's how we put this all together. We have 2 companies, a good company that had 1% improvement in diversity, and a company with an opportunity because they had flat diversity. Here, 0.56 to 0.57 is the diversity index. And the HCROI goes up $2.31 to $2.41. And the resulting profitability, EBIT, earnings before income tax, goes up 35% from 2020 to 2021. In this company where HCROI goes down, profit still goes up, but it's dampened, right? It only went up 16%. In this organization, HCROI helped the company become more profitable. So your target is to improve HCROI, and you can do that in lots of different ways. You can do that with retention. You can do that with better recruiting. You can do that with better productivity, employee productivity. And you can do that through what we're seeing now is better diversity. And the correlation is pretty strong between diversity and HCROI. So that's a good place for you to look. Okay, the other thing that we want to look at is not just the absolute performance year over year in diversity, but we also want to understand whether or not your organization is actually outperforming your competitors. And that's what investors want to know, right? So investors, this presentation, we're speaking to the investor stakeholder. We want to show investors that we are becoming more diverse, because as we become more diverse, we have better HCROI, and the better our HCROI is, the better our profitability is, right? But investors also want to understand whether or not you are outperforming your competitors on diversity. And again, with the same two companies, company A and company B, one is more diverse, one is less diverse, right? We saw company A go up in diversity, company B stay flat in diversity. But we also want to understand whether or not they're outperforming their competitors. And here, company A has 42.2% diversity compared to all companies in their NAICS or their industry sector that only has 38.7%. Where do we get this data from? We get it from the EEO1 database. It's available to you. You can go and search for it. You can draw data down from the database. You have to figure out what NAICS code you're in, and then you can compare your own level of diversity to the publicly available data through the EEO1 database. Here, company B is less diverse than their competitors. This is the company where diversity stayed flat, so they're not even making progress in the market. So this is the other thing investors are looking for. The third thing that investors are looking for is not just how diverse you are, but where your diversity is and how competitive you are to the marketplace for diversity in key areas. So most companies say, oh, we made progress in diversity, but what happens is they make progress in diversity at the very bottom jobs, at the crafts, operator, labor, and service job classes, right? And they don't have diversity in their senior level jobs, in their management jobs, in their exempt level jobs, right? Professional, tech classes, sales jobs. And that's what investors want to see. They want to see that you are diverse throughout the organization, not just in the bottom ranks and the non-exempt ranks. And what we do is we look at the percent performance of the company to the competitor group against all these job classes. And you can see this is our more diverse or our better company is outperforming the marketplace on executive management, professional jobs as compared to their competitor groups. And that's what the investors want to see. They want to see more diversity in the senior roles. Here in this organization, they are trailing the competitors for all job classes, every one of them. So investors don't like to see this, because if you believe that the more diverse you are, the more profitable you are, this company is not getting there. The other thing that we like to look at is where the diversity exists. So this slide was overall diversity, but we can look at each one of the race, gender, and ethnic categories to understand where the diversity is coming from. So in this organization, the more diverse, 19% of their population is Black African American, compared to this organization where it's only 2%. And then we can also see how the competitors show up, right? So in this organization, the competitors have 2% of executive senior job class as Black African American, and in this company, they're at 6%. So that's a great story, right? Here, Black African American is 4%. For this organization, they actually outperform, but every place else they underperform against Black African Americans. So it's not just our overall diversity that the investors want to see, it's where that diversity is coming from. So that's the things that we look for. So just to sum up, what we looked at was the relationship between diversity and HCROI, and profitability. So now we are explaining why more diverse organizations have better profitability performance. We looked at diversity year over year. We looked at diversity against a comparator group, which is all companies within your SIC code. And we want to now create the narrative. So here's some indices and resources that are available to you. I'm sure that we'll be sending the presentation to you. These are all hot links in here so that you can see what you want to, what we're referencing. These are the indices that are available. There are a couple of ISO standards that you should be thinking about. The ISO 3415 standard, which is the diversity and inclusion standard, is super important, and investors are going to start looking to see whether or not companies are actually certified against that standard, that global standard, the International Standards Organization standard. So what investors are recommending companies do, not just have your chief diversity officer as a corner office role, to focus on your commitment to the critical role HR has in driving diversity, create a compelling narrative. It's great that you have good performance, but if you cannot communicate that, all is lost. So at the conference board, we created this report called Telling the Human Capital Management Story. There's a hot link. The report is free. I was one of the authors on that report. So download it and study it. That will give you a roadmap for how to communicate to the different stakeholders. And what they're looking for, what investors are looking for, is a commitment to accountability and performance. I put those in red because it's not enough to talk about policy. You now have to create data to support your position, your performance. They want to see a track record. They want to see how you perform against competitors. And they want to see a sustainable relationship between diversity and corporate financial performance. So you can do it yourself. We've given you enough information and enough tools so that you can do that yourself. Or if you want to get an audit, you can take an Uber, you can reach out to us, and we can create a report for you that has over 70 analytics, has 40 dashboards. We'll pull the data from the EEO database. If you want to understand your performance against a local geography in terms of whether or not your workforce represents the local labor force, we can do that for you as well using Bureau of Labor Statistics. And we can help you with the 3415 certification. Also, this information that you're creating now is going to be critical in terms of the future disclosure requirements, both SEC and ESRS, which is the European required disclosure on human capital performance. And all of that is coming down the pipeline. So you have to anticipate that in your role to help your organization with those disclosure requirements. So I'm going to turn it over to Joseph now.
Hi, everybody. Once again, thank you, Solange. That was great. I loved the way you sped through it. You really gave us a lot of great information. As both Pablo and Solange said, we will send out a link to the slides and the video. Anybody who is participating today and responds within 24 hours will get a 15% discount. And then Pablo has been monitoring the chat throughout for questions. I'm going to turn it over to him in just a minute. If you have any questions at all about anything or want more information, don't hesitate to send me an email at jolowitz@hcmoneyball.com, and I will respond real quickly. Pablo, I don't know what you've got there. Do you want to ask Solange some of the questions? Pablo?
Pablo, you're on mute.
Only once in every webinar, right?
No, we still can't hear you. Okay, while Pablo is working that out, here's an unabashed plug for my book. So thank you if you've already purchased it. There's a QR code here that'll take you to our book website where you can pick any of the places where you buy books, Barnes and Nobles, Amazon. We don't want to force you to do Amazon, so we've got the book in all all outlets. So you can just use the QR code, it'll take you there and you can order the book. And Pablo, are you on?
Can you hear me now?
Yes.
Yeah.
Excellent. So we have many questions and I'm going to go in order. Well, Kurt is asking if you have a book on this topic. Yes, we are going to send the link. Stacy Collins, do you want to ask the question yourself?
Yes, thank you. Hi, Solange. always a pleasure to listen to you, and you're just your brain is just amazing and astounding. And again, I love your book, and to those who are on this webinar, I cannot recommend it more highly. So my question to you, though, is especially with all the economic uncertainty that's happening right now, how can we ensure that DEI maintains momentum? And I know that you've shared some of that just in how to kind of represent it, really when it comes down to the bottom line, and that is from a profitability standpoint or a return on investment standpoint. Um, is there anything else we should be thinking about, or how we can leverage this information to ensure that when we're having those conversations with our leaders, that DEI isn't just a nice to have, but that it's imperative to the business?
Yeah. And it's a great question. And DE&I essentially checks all the boxes when you think about stakeholders. So we're only talking about investors today, but we're going to talk about how DE&I actually impacts all the other stakeholders. And when you go to your management team and you go to your board, then Stacy, I don't think this issue is going away because it is a board issue. Board of directors are now talking about DE&I and DE&I sustainability and DE&I financial impact. And when this issue is taken up at the board level, it doesn't get swept aside because boards are going to hold management accountable for it. And when management is held accountable, everybody participates, right? So this conversation today really talks about the material impact. And bottom line performance is always going to be first and foremost for executive management teams and for boards. And what I suggest is that every organization that's today in this room and every organization in the world, and maybe it's not a worldwide issue because really DE&I is a European continent, an American, North America and South American continent issue. When you get to Asia Pacific, they have less diversity in their workforce. It's more homogenous. So they don't have that big of an issue. It's really the Western world that is thinking about this. But bottom line performance is key. And there's a question about the relationship between diversity index and HCROI. Is it a direct correlation? Yeah, it looks like it's a direct correlation. And another question was, is it statistically significant? And my answer to that is not yet, because the N so far is 26, and I don't think that's big enough for statistical significance. But when you look at 26 organizations that all essentially have the same pattern of performance related to DE&I and HCROI performance, that's pretty strong. That's a pretty strong 24 of 26 had consistent patterns. And I think that's pretty interesting. This year, because we've collected about 80 or so EEO1 reports from companies, we're hoping to be able to do this research 2021 to 2022 on 80 companies. And then we'll be able to really understand statistical significance amongst these variables. And of course, we're going to be writing about it. Don't worry, we'll be the first ones out there. So Stacy, I think that first and foremost, this is a material impact. You should be evaluating your own organization to understand the relationship between DE&I and HCROI and profitability. And if you present that to your executive management team and take it to your board, this is not going to go away. And even if you have bad results, there's enough information. You saw the Refinitiv that there is a relationship between diversity and market cap. It's up to you to make sure that that relationship goes in the right direction.
Pablo, more questions?
Solange, we have many questions, so I will ask you to be briefer when you answer. Okay. Anonymous asked, do you have suggestion for how to measure human capital return on investment for non-profit organizations?
Yeah, you can measure HCROI regardless of your profit, nonprofit status. Instead of using revenues, instead of using revenues, you're going to use your top line budget. And and you're going to use expense. That's universal for all companies. So your top line budget really is the same as your revenues, because that's your, where you get your funding from, right? So all nonprofits have a line that's essentially the same as revenue, which is your top line budget. All organizations have expense. You use the same thing. And instead of measuring profitability, nonprofits measure surplus or deficit. So surplus is going to be the positive, right? When your expenses are less than your budget. And deficit is when your expenses exceed your budget and you're in the red. But you can still calculate HCROI for the nonprofit organization.
Pablo?
Megan asked, tell us more about Apple and Centene and what your theory is for why they are not tightly correlated.
Okay, let's go back to, here's Apple. So it doesn't make any difference whether or not, because we're using two different axes here. The lines don't have to be on top of each other. We're just looking for the slope of the line. We're looking to see that they both go up, or they both go flat, or they both go down, or one goes flat and one goes down. So for Apple, their diversity index went from 0.6805 to 0.6807. So a really small improvement, but it did go up. And their wrong line, 0.679 to 0.6801. Again, a small difference. And their HCROI went from about $13 to about $16. So we're looking at the directionality. So it's positively correlated. Both went up. So the lines don't have to be on top of each other. We're just looking for the slope of the line. And then Centene, the same idea, their diversity went way up and their HCROI went from about $9 to about $12. Right? So again, it's the same directionality.
It's amazing how very small changes in diversity correlate to big changes in ROI and value and net worth of the company.
Yeah. And again, on this side, on the right axis, you can see the different HCROI measures. So for Adobe, right, it's in the $2 range. For American Tower, it's in the $7 to $8 range. For Apple, it's in the $10 to $18 range. So you can see some are single digits, some are double digits. And it depends on your business and your business model, but we always want to see HCROI go up because that drives profitability, right? Makes companies more profitable when you are more efficiently getting a higher return on your investment in people. And again, different companies have different ratios of how intense their investment is on people. For REITs, maybe they only have 10 or 20% of their total expense going to people. For banks, like Bank of America spends 80% of their total non-interest expense on people. So some companies are very labor intensive in terms of their investment. And when that's the case, small changes create big impact on bottom line performance because that's where you're spending most of your money.
Megan is raising her hand, but I think I will go through the rest of the questions and then we can have a conversation. Kurt asked, is this a direct correlation? Kurt, what do you mean? What part of it? Are you still there?
I answered that already, that
okay.
We can see when the lines go in the same direction,
right.
It's a direct correlation. Now, whether or not this is statistically significant, I can't answer that yet. Give me one more year, and then I'll be able to answer that. If we ran the numbers, we would find a statistically significant relationship. But at the end, for my comfort, based on 26 companies, I don't want to say that's how the whole universe goes. I'd rather wait until we get more data. And if all next year or this coming year, when we do this analysis, if we have 100% relationship, then we'll have more confidence in the fact that this is statistically significant.
Anonymous is asking, do you have statistical measures for validity, like correlation not being causation?
Yeah, I just answered that.
Okay.
So right now,
I'm just...
Right, I got it. So right
Yeah.
now, all we're seeing is correlation, and we hope that with future research, we'll be able to show some high level of statistical significance. As a researcher, I'm always uncomfortable saying there's causation. I'm comfortable saying there's correlation, because there are lots of things that can impact
Exactly.
these, human capital is a multivariate function. There isn't just one thing that drives HCROI, but and I would imagine that the more diverse an organization is, the more it tends to focus on human capital, which means it has better programs, which means it has better engagement, right? So there's lots of things that go into that, but these are the measures. These are the things that we can turn to and say, yeah, take a look at this. There's something going on there.
Dominic is asking, are some diversity categorizations, example, race versus age versus sexuality, somehow more profitable than others?
I can't answer that. All we've done so far is look at diversity based on race, gender, and ethnicity, which is what the EEOC measures. As the market becomes more sophisticated, more evolved, and we look at things like age and generation, and we look at LGBTQ+, and we look at ability disability, then we'll be able to answer that question. And you can look at that in your own organization. If you've got information about age and sexual identity, run the numbers, do your own Simpson diversity index and correlate it to HCROI and profitability and satisfy your own curiosity. And again, if you don't want to do that, come to us and we'll do it for you.
Dominic also asks, are there any other factors or dependencies that affect DE&I performance, such as industries, legislature, target market, local, etc.?
Yep. All of those do, and that's why we benchmark to the EEOC database so that we can capture performance by industry. And we look at the BLS data to capture performance by geographic location. So great question, and yes, we have a way of understanding those other factors and dependencies.
Real quickly, Solange, sorry to interrupt. Can you point out to people how the benchmarking is represented to them if they get a report from us?
Yeah, absolutely. So in the benchmark data, we analyze your performance, which is the light blue line, and then we pull data from the EEOC database for the EEO1 data based on industry code. So if this particular company is an NAICS code 51, industry 51, this particular company was an industry 54. So we actually pull the right industry data, and then we show you how you compare against that industry based on each job category, or in this instance, all jobs, just overall diversity, to compare you to your competitor group.
Thomas Fuller said, great job, Solange. Yay!
Thanks, Tom. And thanks for being a fan.
Dominic is asking, is it possible to compare within an organization?
Absolutely. If you've got the data, if you, like, say you're a multi-division company and you pull EEO1 data, you create EEO1 data based on each one of your divisions, you can do this analysis division by division. You'll still benchmark against industry, right? So, or let's say, I have a client that is in several industries. They're in hospitality, they're in manufacturing. If they create the EEO1 data for each one of their industries or their divisions, we can benchmark them to the proper industry that they compete in. So yeah, you can analyze the data within your organization and also benchmark it to the appropriate competitor group and take a look at how you're doing internally and year over year. And what would be interesting is if each one of your divisions has its own P&L, you can figure out whether or not the more diverse divisions in your organizations have better financial performance than the less diverse divisions do.
Kurt,
That would be really cool.
Kurt had to go, but Megan wants to reach out to set up an introductory call. Megan, I will reach out back to you very soon, and we can talk as soon as we are done with these questions. Mary King, when I present this type of information, diversity, profitability, I get pushed on proving causality, not correlation. I'm sure you have heard that also. Any advice on how to respond?
Yes, I do. If you do this analysis that we just showed you now, where you're calculating HCROI and you're calculating your diversity index and you're looking at your financials, we are moving the diversity discussion from qualitative, which is policy oriented and employee experience oriented, and we're moving it into the quantitative realm where we're talking about diversity as a driver of economic value creation. And your management will take a look at that. Your management doesn't know how to process qualitative HR information. They don't know what to do with statements like we're more diverse or less diverse. They don't know what to do with statements like we have high engagement or low engagement. You have to correlate it to something that they can understand, which is corporate financial performance. That's why we gave you the HCROI number. Calculate your HCROI for last year or this year, or do it by quarter. Calculate your diversity information and look at the two of them together like I just showed, or like what's on this slide. I'll go back to this slide. Create a slide like this for your company. I promise you, your executive management team will pay attention.
Thomas is asking, talk about high CDO turnover rate. Many say are attributed to preventable factors such as a lack of resources, a lack of accessibility to company executives, and a lack of company-wide mobilization toward DE&I best practices.
Right. I don't know how to explain the high CDO turnover rate. That's not my area of expertise around talent development, talent acquisition. But I can tell you that the CD&O role, based on what the investors are looking for, is going to be a hot role. And organizations are going to allocate more and more resources to the CDO function than they have in the past. And I know that to be a fact because this is now going to be a reportable piece of information, a reportable area for public companies, and both in the United States and for companies that do business in Europe. And so now that there is a required disclosure horizon, companies will be allocating more resources to this area. It's not going to fly under the radar anymore. It's going to be a blip in the radar, which means more attention is going to be given to it.
How are we doing on time?
I think we're way over time, and I'm, grateful to everybody who stuck with us.
Megan, did you have a particular question, or do you just want to talk apart? Where are you?
Hi, can you hear me?
Yes.
Yeah, that's fine. I've got to jump off, but
Right.
I will reach out separately. Thank you.
Okay, cool. We will reach out to you. Okay. Any other questions? Anyone else that want to just raise your hand? Okay, I guess no. It was an amazing session. A lot of people showed up and a lot of questions. This has been amazing. Thank you very much, Solange. Again, everybody, I will reach out. Joseph will reach out and share the decks, links, and answer any questions.
Bye, everyone. Thank you.
And please come to the next 4 where we're going to be unpacking the other stakeholders' concerns and how to use DE&I to address those concerns and amplify your company's impact.
To what's the next session? Which stakeholder?
The next session stakeholder is going to be employees.
Excellent. Very good. Okay. Thank you, everybody. Thank you very much for coming.
Thanks.
And see you in the next session. Bye-bye.
Bye.